Welcome. Thank you so much for joining us. I think this is the third time you and I are sitting at this conference having a conversation, so I am delighted. And I should just announce to everybody that I have a cough drop in my mouth, so apologies for whatever that looks like. Dalia, before we jump in, I do want to ask you about relief that the division issued yesterday, the no action relief in response to the coronavirus. So why don't we start there?
So good morning, and thank you for having me again. I really look forward to this conference every year and sharing with all of you what we're doing and why we're doing it. Before I start and get into anything substantive, just a usual disclaimer that anything I say are my own thoughts and remarks. They are not the thoughts or remarks of the commission, the commissioners, or my fellow colleagues on the staff. So we had been increasingly hearing that there was some concern about travel restrictions and an ability to travel for board members and how that would impact upcoming board meetings. We had issued a letter last year to the IDC, a no action relief that covered certain circumstances, emergency unforeseen circumstances, and the renewal of advisory agreements, for example. We had heard, obviously, that under the current circumstances, it could be broader scenarios that would warrant relief, so we wanted to go out ahead of that and cover that. The relief extends until June 15th of this year, but we also made it clear that should the circumstances warrant, we would be looking at extending. So again, this was one area we had heard there was a request for relief, and we have been proactively reaching out to folks, including the IAA, to hear about any other areas where relief might be necessary, so that we are prepared, and encourage any of you, if you have any concerns or thoughts in that area, please do reach out to the staff.
Well, thank you, and I think we've all found that extremely helpful, so thank you for that. You actually have been working on other things other than the coronavirus, so it's been a busy year, and I'd love for you to tell us a little bit high level what you think the division's accomplished and what your priorities have been.
So we've actually done quite a lot. I think as you all know, the two drivers to our work have been the Investor Experience Initiative and modernizing our regulatory landscape. And with that, we've had some really significant movements. Just by way of example, I don't think time would allow us to go through all of them, but by way of example, with colleagues in Division of Trading and Markets and many colleagues throughout the Commission, we worked on the standards of conduct rulemaking. For the modernization initiatives, we worked on ETFs. That was pretty significant for the division, and not just the rulemaking, but also we have the first actively managed ETF that would not reveal daily portfolio holdings. We worked on proposals to modernize other areas such as derivatives, investor advertising and solicitation rules, proxy guidance, got that one out as well. We also have, the staff and disclosure worked really hard with a sponsor to get the first closed-end fund that would invest in Bitcoin futures, that worked very, very closely with the sponsor in all areas of concern that we had mentioned about 2 years ago. And all the work that we have done, that was alongside all the routine work the division does on a daily basis, including all our disclosure reviews, all our guidance work, our SOX reviews, our assist to the Division of Enforcement. So we do an incredible amount of work on a daily basis, aside from all the policy initiatives that we have done.
So if you could have to pick just one, what are you most proud of this past year?
I'm really proud of the work that we have done in pushing forward both our pillars. The work we have done in the standards of conduct rulemaking, both working with trading and markets and regulation best interests, where obviously they were lead, putting together the fiduciary interpretation, bringing in one place the fiduciary interpretation for investment advisors, and Form CRS, a form, a two-pager that would allow investors at a high level get information about the fees, the services, the conflicts, the disciplinary history of a financial professional so they can make an informed decision on how to select an investment professional. That work was, the folks in the commission, staff in the commission have been working on this for a very long period of time, and seeing that to completion was obviously a very significant accomplishment and great for investors in the end. But also all our work to modernize regulation. This is a dynamic industry. it's a very diverse industry, and making sure that our regulatory infrastructure is keeping up with market developments, with technology, with changes in investors, with changes in how investors look to advice, to make sure that we are, on one end, investor protection mandate is there and protected and heightened where it needs to be, but also capital formation and opportunities to investors are also there. So all our work in that, being able to get the projects that we said we would do across the finish line, it's a major accomplishment for the division.
Yeah, it's clear that you've been so busy and have put out so much stuff, and we're very appreciative of the efforts, and particularly around modernization. The IAA has been working with you on that, with the division and the commission for years, so we're so happy to see a lot of movement in that area. So speaking about that, there are a few outstanding rule proposals that I am going to want to touch on with you. We're going to want to talk about marketing, derivatives, accredited investor, and proxy. So why don't we start with the marketing proposal? And the comment period closed a few weeks ago. The IAA submitted a 79-page letter. Apologies for that. Some may say it's long. We like to say it's comprehensive. But I think the gist of it truly is that we are very supportive of the direction that the Commission is going. We appreciate very much the principles-based approach. And I think you've applied this, you've talked quite a bit and applied this to other rulemakings about the concept of having things be evergreen and be able to evolve with the market. So that's very much appreciated. And also I think your explicit statements, the Commission's explicit statements around trying to streamline the maze of no action letters. So strong support for that direction. We do have a couple of questions, and are kind of curious about your thinking on some of the more prescriptive elements. And Commissioner Lee spoke this morning, and she was asked about, for example, the breadth of the definition of advertising. So that's one I'd love your thoughts on. And the other one is the compliance requirement, the pre-review requirement. So if you could just tell us a little about what's prompting those.
So first, in your 79-pager, I think the margins were a little bit narrow. The font was very small and, not even single-spaced. And I think it might have been longer than our release. So I was expecting an economic analysis tagged on there, but.
I would push back, but that would be rude.
No, seriously, we have received, I think, around 60 letters so far. And one of the things that really, just about the letters, what really strikes me is people have really taken to heart what we have been asking, which is, proposals, everybody's going to find something in it that they don't like. It may not work from a compliance perspective. It may present other issues that we had not perhaps foreseen when we were putting the proposal together. And we've always asked, don't just highlight the issues, but please provide us with constructive solutions and ideas. And I will say the comment file really does reflect that. And also what it does reflect is, this is a rule, it's investment advisor, advertising and solicitation. But when you look at the community that it covers, it's an incredibly diverse community of advisors that have, from retail investors to institutional investors, private funds. I mean, it just is a very, very diverse community. So the fact, robo-advisors, so the fact that we were able to get comments from that diverse group of market participants that would be affected by the rule, we are definitely, as a staff, we're very appreciative of that because it does help us fully understand the potential impacts and how to think about the rule proposal. I think you summed it up quite nicely. The two areas I think we got, again, it's only been a couple of weeks, so we're still in the process of digesting the comments, but the two areas that seem to stand out in terms of comments that we have received have been around the definition of advertising, the scope, and also around the compliance review aspect of the proposal. And we definitely appreciate all the constructive feedback folks have given us as to where those two areas could present potential problems. And one other thing about your letter that actually I should mention we found extremely helpful, you had a very helpful chart that went through all the prior guidance. That was really, really helpful.
That was 78 pages. So.
It was actually a good portion and extremely helpful. When we were putting this rulemaking together, it was really not a simple task. It was probably one of the harder proposals for us to bring together. You have to keep in mind what we started with, which is a rule that was adopted back in 1961, the advertising portion, which predated the internet, predated a lot of market developments, a lot of communication developments, technological developments, and then a slew of guidance that had to be issued to try to make the space evergreen and workable. That was not an easy task to put that together into a framework and a recommendation. So, and going back to a framework and recommendation that covers the diverse market participants in this area. So we definitely appreciated the comments, definitely appreciated all the feedback on where this could present issues, and the staff is already working pretty hard at moving forward with our recommendation.
That's terrific. While we're talking about sort of prescriptive approaches, another question that I think I wanted to get your thoughts on is around the derivatives rule and the proposal around a new sales practice rule for advisors. What is the thinking there? It seems to us that it's not necessarily consistent with the principles-based approach, and particularly since the fiduciary duty and all the duties they're under were reaffirmed very recently in the interpretation. So I'd love to get your take on why you think this approach is important.
So the derivatives rulemaking, the basic framework is that was proposed was a risk management program that's principles-based, a risk-based limit, the VAR limitation, and the derivatives risk manager, which would have to be a qualified derivatives risk manager. One of the issues, a levered ETF would have to comply with all of these elements, aside from we gave an alternative to the risk-based VAR limitation, given the strategies of these funds. Given that, we had to look at investor protections for investors in these funds, given that the VAR limitation was different. And with that, the rule essentially requires a level of due diligence by investment advisors and broker-dealers that would accept or place their clients in leveraged, not just ETFs, by the way, but it would cover ETPs, exchange-traded products, not just 40 Act ETFs. And with that change as well, the Commission proposed to allow leveraged ETFs to rely on 6C11. Also with the rule proposal, the Commission did publish a paper that was done by our colleagues from the Division of Economic and Risk Analysis that looked at leveraged ETFs and came to the conclusion that they had an options like features. And so the rule that we proposed for the due diligence actually borrows from the options qualification regime. A retail investor today cannot, buy an option on the market. Their account would have to be qualified. It would have to be a qualified options account. And so with the same thought process, we borrowed that concept of due diligence because, again, these are products that have options-like features. The economic impact, if you will, is very similar. And so that, in a nutshell, is how we came to the design of the proposal. The comment period has not yet closed. It closes in a couple of weeks on the 24th, I believe. And we've been getting a lot of comments. I'm sure we'll get quite a few more, and then the staff will be looking at the final recommendation from there.
We will add to the pile of comments, probably not quite the heft, but the pile. So let's switch gears to proxy voting. Commissioner Lee spoke this morning and she talked about proxy voting. And there are two pieces that advisors are interested in. One is the guidance that was issued last summer for investment advisors, and the other is the proxy advice proposal. So on the guidance first, are you getting any feedback from folks on that?
Generally, anything we've heard is that it's well received. It's in line with the fiduciary obligations. So we've not heard otherwise. If obviously anybody has any thoughts for us, we always welcome thoughts.
Yeah, so I will say that some of what we've heard from our members on that is that the level of detail and the sort of, I know it's not intended to be a check the box, but there are some check the box like elements that folks at least feel are sort of check the box, and there's a little bit of concern that it's something new. So people are trying to synthesize it, work through it as we approach the next proxy season, but you may hear some of that kind of feedback from us.
We gave examples when we said, this is an area that you should do something about. We thought it would be helpful guidance to give examples. That's not a check the box exercise. It really simply is examples of how one can meet the obligation, and they were clearly delineated as examples.
Okay, that's terrific. So it's guideposts. It's not prescriptive elements.
It's guidance.
And now, what about the recent proxy proposal? Again, the comment file is building up, and the IAA, our concerns are that we don't want anything to increase costs. We don't want to make it harder for advisors to vote proxies in their client's best interest. So I'm interested in how you're approaching what you're seeing in the comment file.
Again, this is one where the comments are still incoming on this one. The comments have been extremely helpful. The two rules, they're 33 Act, so the Division of Corporation Finance, we're working with them on that project. Of course, being investment management, our focus is on comments and ideas that are coming from the asset management space. We like with every single rulemaking, we take every single comment seriously. We do look at it. We do try to make sure that we are looking at any significant issues that are being presented, and that we are putting together a recommendation that we believe is in the best interest and that is workable. We are mindful of regulatory costs. We are mindful that we do want to make sure that shareholder voting is something that's top of mind. So we are mindful of all of that as we will be working through this one with the Division of Corporation Finance.
Terrific, and I can actually vouch for the fact that anytime we've submitted something and then gone in, it is clear that the staff is reading comment letters, and that again is very much appreciated, because from our end a lot of effort and thought go into our comments, and we try really hard to be constructive. So it's just wonderful. I want to give a shout out honestly to your staff for having such an open door, an open mind policy. So another thing that Commissioner Lee also talked about this morning was accredited investors. And the Commission issued something yesterday on exempt markets. We have not fully synthesized and processed it yet, but it looks like there are some good nuggets in there. I think we're going to be pleased with some of what's in there. But we have long supported expanding the definition of accredited investor to discretionary clients of investment advisors. So how do you think about that concept? It's not in the current proposal. It's something that we will keep asking for. So we'd love your thoughts on that.
So for me, when I think about that, for us, it's what we're calling the private access, right? It's the retail access to private markets. As we all know, companies are staying private longer, almost double the life cycle between when they used to go for an IPO and when they're going now, which does mean that investors are not getting an opportunity to participate in the late growth phase of earnings. And so this is something the chairman has spoken about, and we are looking at private access. I mean, fundamentally what you are asking for is that concept. We are looking at the private market is a certain market, the public market is a certain market. If you look at the Investment Company Act, it made a very, not fuzzy, not gray. I mean, there's a delineation between the two. So we want to make sure that as we are doing this, as we're looking at the private market, or as we're looking at private access, that we're doing it in a way that really preserves important investor protections. We're also mindful of the fact that retail investors, really did used to get access, and some still do, through defined benefit plans. Increasingly, as defined benefit plans decrease in our landscape, and defined contribution plans and IRAs and other ways of saving for retirement become the norm, and this access, which used to be part of what retail investors had, and some still do have, increasingly that is an access type of investment that's not available, and it is important for it to be available. So we are really working really hard on this, trying to make sure that we think about the best vehicle to provide this access, while at the same time making sure that we are preserving investor protection. So, I mean, the heart of your question, it gets to that same issue that we are looking at.
Yeah, and that balance is critical, obviously, and how to strike it is critical. But as you're kind of saying, it's really important that it all evolve with the markets. And one place where we're seeing a big market change is the bond market's reliance on Rule 144A as more of a permanent pathway rather than a temporary and then move to public pathway. So we're hearing lots of questions from our members about their ability to access the bond markets for retail investors and sort of plain vanilla bond markets. So I'm kind of wondering if the division is open to sort of considering any changes in the QIB definition area.
So the QIB is not one of our rules.
Qualified institutional buyer.
Yeah, so that's more in the 144A space. So, I mean, we are looking for any good ideas. We're happy to listen to any good ideas on how to provide retail access to the markets in a way that preserves investor protections and makes sure that the opportunities are as good as any opportunities available to institutional investors, and that retail investors are not paying a cost for that access that would be more than what an institutional investor is getting. So we are open to ideas. As I said, it's an area that we are actively working on.
Well, that's great. So moving to an area that you and I have talked about more than probably you want to talk about, custody. So we are, of course, delighted that it's on your agenda. It's something that we've advocated for a long time. And this time last year, your division sent a letter out to the IAA asking for input on some specific items, elements of custody, non-DVP and digital assets. It's been a year, but we're still working on it. We have come in and met with the staff a couple of times. And the other thing that we're working on is really an approach or a suggested approach to thinking about the custody rule writ large. So we'd love to get your thoughts on your thinking, where you are, and whether when you think about the custody rule broadly, you're looking at it as a kind of a clean slate approach or a tweak the current framework approach.
Yeah, so this is a rule. We have a great team working on it. And I think I mentioned it before, when you have a situation where the FAQs in the rule are longer than the release on the rule, then you do have to look at whether the rule is working in the way it was designed and intended to work. We continue getting questions about custody-related issues. And so with all that, it sort of went to the top of the list of an area that we do need to look at. And when we are looking at anything with our modernization lens, if you will, we don't come into the table with a preconceived idea of what it should be, whether it should be a wholesale change or a tweak. That's not how we're looking at it. We're looking at market developments. We're looking at the concerns that the rule was designed to address, or that the space, if you will, is designed to address. And then we are looking at evergreen solutions. So with everything, that's how we are approaching our work when it comes to modernization. We've had some great input. We've had a lot of experience in areas that we do know are creating friction right now in terms of complying with the rule. And so we are really looking proactively at how to move the space forward in an evergreen approach and a streamlined approach, but most importantly, an approach that does protect investor assets. Ultimately, this is a fiduciary obligation, whether or not you're looking at the custody rule and its mandates. It is a fiduciary obligation to protect customer assets, and so we're very, very mindful of that. And we are really still remain open to any ideas different participants in the industry have for us and how to move this regime forward.
Okay, so we want to cover a lot of different topics, and I really appreciate your willingness to just sort of flip back and forth. So let's switch completely and ask you about MiFID. You recently extended the no action letter on MiFID. So we're curious about whether there's any appetite to make that permanent. And what I'm particularly interested in is your thoughts on how advisors that are not subject to MiFID, so they cannot rely on the letter, and that means that they cannot pay cash for research, on whether you're thinking about the impacts on them and how that might all fit together.
So this is a project that we have been working on for a very long time, and we have gone out over and over and over again asking for input, for feedback, for ideas. We did extend the no action relief, and in that extension there is a standalone footnote 8, that talks about CCAs or CSAs, and provides guidance on that, because we were hearing some questions about the use of CSAs. So that one is in there, and it's a standalone footnote. We are continuing to go out and ask folks for ideas and solutions on how to address the MiFID, the implications of the MiFID regime here in the United States. The letter, as you note, is really limited to advisors that are subject to MiFID, or brokers are subject to MiFID, so it has a limited scope. We are continuing to ask the question of need for unbundling in the United States outside of like the CSA regime, how that would work out, conditions, just everything around it. We do find, and unfortunately, when we do give relief, which is several years in the future, people tend to drop that in the priority list. We just do ask that if this is an area that does affect your business, please do not drop it down the priority list. Please do come and talk to us and provide us with ideas and solutions. We still need them.
So you may think that all we do at the IAA is write letters. We're working on a MiFID 2 letter. You'll be hearing from us hopefully very soon. We have some thoughts on that as well. You mentioned early on CRS. So we don't have much time, and I want to maybe see if we can take a couple of questions. But are you thinking of any more FAQs, anything else in the pipeline?
So, as you know, we have the implementation committee for the standards of conduct. We are still getting through our email inbox. We're getting questions. As we get questions, that team is continuously working on responses and seeing which ones are sort of frequently asked that should be going out in that manner. So we are continuing that process. We are available to answer questions on any parts of the standards of conduct rulemaking package. Compliance date is coming up, and so we appreciate that perhaps more technical questions will be coming up as you are looking at compliance. So we are available. If there are questions, we're answering them. Happy to take more, happy to continue answering them.
Well, that's excellent, because folks are working really hard to get that form up to speed before June. I think it's June. So I don't sort of see any audience questions right now. So let me ask you about another item on the recent fall Reg Flex agenda, 13F filings. This is also something that comes up periodically because, as most of you probably in the audience know, you have to do a 13F filing if you hit $100 million in Section 13F securities. And that threshold was set in, I think, 1974, has not been updated. So thrilled that it's on the Reg Flex. But what is your approach to updating going to be?
So let me start this one actually by saying, so we launched last year our Small Advisor Outreach Initiative. We've gone out, we've spoken to over 40 small advisors, and they've been just absolutely phenomenal in giving us ideas about modernization of areas that would be impactful to them. And this is one area actually that they noted would be impactful. And so yes, we started looking at it at the threshold. It really has not moved since adoption, which was, as you noted, quite a while ago. So we are looking at the threshold, at the market movement since then to see how we can move the threshold.
Great. So in the time we have left, I wonder if you can just very briefly talk about another initiative that we think is great, the Asset Management Advisory Committee, and a little bit about the process and how it's going to work with the division.
So again, that was last year. I said I was hoping that we would be able to launch the Asset Management Advisory Committee, known as AMAC now. And we were really delighted that we had the support of the commission and were able to launch it. It had its first inaugural meeting earlier this year. And it was really it was a great meeting where we were able, from different participants, the panelists that came, they gave a wonderful overview of the asset management industry and the evolution of the asset management industry. I think you've heard me talk about this before. For us to be informed as regulators, for us to regulate the industry as it evolves and moves, we need to understand where the evolution is. We need to understand how it's evolving. And so having this informed debate, having diverse members of the asset management industry is extremely diverse. So having that diversity represented in that committee, talking about the different issues around evolution of the asset management industry, evolution of the advice model around the asset management industry, and hopefully come to us with ideas, recommendations, solutions. We're really, really looking forward to their work. And the chairman of the committee, Ed Bernard, has just been absolutely phenomenal at helping us get the committee off the ground. And the first, if the first meeting is any reflection of what's to come, I think it's going to be really, really great, the input that we will be getting from the committee.
I think that's a terrific high note for us to end on. Dalia, it's been a pleasure, truly. And I know that everybody in the audience appreciates just how open you are and how much you're really willing to talk about. So much appreciated by the IAA, much appreciated by the audience. And thank you again.